Hey everyone, are you ready to unravel the secrets behind the bullish markets?
Absolutely. Today, we've gathered insights from leading financial minds like Danielle DiMartino Booth and Cathie Wood.
With rising bond yields and potential bankruptcies on the horizon, it's crucial to stay informed.
Exactly. Let's dive into what these experts have to say about the current landscape.
And remember, this is educational content and not specific investment advice. Today, we're diving into the game-changing world of autonomous labs with Nemo from ARK Invest's genomics team.
Nemo uncovers how AI and robotics can redefine the drug discovery landscape.
But how does all this work? Can machines really outperform human researchers?
Let's find out what Nemo has to say.
Autonomous labs are revolutionizing how we conduct scientific research.
Right, it's like having self-driving cars, but for laboratories.
So, how are these new technologies currently being applied?
Recent studies show real-time lab simulations where AI agents collaborate on antibody development, achieving results in record time.
Nemo pointed out that AI can cut years off the antibody development process.
That's impressive, but what challenges might arise with AI in labs?
While AI enhances efficiency, human oversight remains crucial to guide experiments and ensure accuracy. By leveraging blockchain, researchers can share IP more equitably.
That can open up opportunities for innovative projects.
But does this model risk oversaturation of funding possibilities?
Absolutely. While it increases access, there's a need for quality control.
So what does the future look like for drug discovery?
Imagine a decentralized model where researchers worldwide can fund and share breakthroughs.
That sounds like a radical shift. How soon can we expect this?
With current innovations, it's becoming a reality faster than we think. The key takeaway is that technology will drive the future of drug discovery.
Exactly, and we must embrace these innovations to unlock potential.
Let's remind ourselves that with great power comes great responsibility.
For sure, it's a thrilling but cautious journey ahead. Recently, India's central bank made headlines for massively shorting the US dollar. But what does that really mean?
It indicates a serious concern for the stability of the rupee, especially as it reaches record lows.
Isn't this just a typical response to currency volatility?
Not quite. The motivations behind this move expose deeper economic weaknesses. Let's dive in.
So the short position is indicative of more than just typical market fluctuations.
Absolutely. It suggests real fears about economic fundamentals both in India and globally.
And what evidence supports this perspective?
The stark decline in GDP growth rates combined with ongoing issues in the shadow banking sector, it's a perfect storm.
The Reserve Bank of India has reportedly built up a whopping $60 billion in net short positions against the dollar.
That's a stark contrast to their previous strategy focused on market stability.
Correct. Such drastic measures signal deepening anxieties about the rupee's future. With GDP growth hitting a low of 5.4%, what does that say about consumer confidence?
It spells trouble. We've seen major companies missing earnings estimates. This isn't just a fluke.
Sounds eerily familiar to trends we're witnessing in the US market.
Exactly. These patterns indicate a broader issue. It isn't just local anymore, it's global.
Doesn't India also face significant issues in shadow lending?
Yes, loan growth has drastically slowed, suggesting a brewing financial crisis.
So the interconnectedness of these factors is crucial.
Very much so. One weak link could trigger a domino effect throughout the economy. What might the future hold for the rupee?
A disorderly unwind seems more probable if the RBI cannot stabilize effectively.
That sounds dire. Could this push them towards capital controls?
It's a possibility if they aim to contain capital flight. In essence, the RBI's aggressive strategy reveals deep-seated fears. Investors need to stay alert.
Indeed, the interconnectedness of these trends should not be underestimated.
We could see ripples felt across global markets if these issues escalate.
Right, awareness is key in such unpredictable times. Stay tuned for our next topic, diving deeper into the dynamics of global currency markets.
We'll explore the implications of these shifts for future financial strategies.
Don't miss out. These insights could reshape your investment outlook.
Today, we dive into Bubble 4.0, examining sky-high market valuations and what they mean for investors.
Absolutely. The indicators reveal a concerning trend. The stock market is one of the most expensive ever.
But haven't we seen this before? What makes this bubble different?
Great question. Let's hear what Jeff and David have to say about this.
We're witnessing a significant overvaluation by historical measures. This isn't just a temporary spurt.
Exactly. Traditional valuations are at record levels, raising alarms for future market corrections.
How should investors react in light of this?
They need a proactive strategy to navigate potential downturns and inflation concerns.
Looking at market cap to GDP ratio, it's screaming overvaluation.
Yes, it's similar to what we reported right before the major corrections of 2000 and 2008.
Could this lead to a significant market correction?
Definitely a risk, especially with such high expectations already priced in. Inflation is turning out to be much stickier than expected.
With rising bond yields and mixed GDP data, how should we interpret these signs?
Is there still room for growth?
Perhaps, but investors must be cautious.
What's the roadmap for investors heading into 2025?
Focus on diversification. Inflation-protected assets will be critical.
Are high-yield bonds the answer?
Certainly, as their risk-reward profile adjusts in the tightening cycle.
What's the forecast for interest rates moving forward?
We're likely to see continued tightening. This might affect consumers more than anticipated.
And how does that interplay with inflation?
It's a delicate balance. Tighter rates could restrain economic growth. To wrap up, it's vital to adjust portfolios in light of these indicators.
Exactly. Proactive planning is essential for navigating the uncertain markets.
It's all about being prepared.
Coming up next, why the real recession data is only coming out now.
Don't miss Danielle DiMartino Booth's expert insights.
Today's economy paints a rosy picture, but Danielle DiMartino Booth suggests otherwise.
Indeed, she examines how the bankruptcy cycle is ramping up, indicating severe underlying challenges.
Isn't it perplexing? The stock market seems unfazed by these economic warning signs.
Let's delve into her analysis of the reality beneath that facade.
Danielle's core argument points to alarming job revisions, suggesting we were hit by recession much earlier than expected.
And she emphasizes that these are not just statistical anomalies.
So what's the consequence of these downward revisions?
It marks a shift in how we perceive our economic landscape. Many are unaware of the actual recession taking place.
The headline number of 12,000 jobs added is shocking. What's the private sector telling us?
It seems scary to think the private sector lost jobs instead.
Precisely. It indicates deeper problems were masked by government job data. Corporate bankruptcies are soaring, with 63 filings just in August alone.
That's a significant increase, isn't it?
Yes, this trend directly reflects consumer debt issues. Credit card and auto loans are rising.
What does Danielle see for the future economic outlook?
Projected recovery from recession seems possible by 2025, but caution is warranted.
With such bankruptcy rates, will recovery be swift?
Only time will tell, but indicators suggest we need to be vigilant.
What can viewers expect as they brace for this recession?
I believe the markets will react poorly to negative data as it emerges.
Should investors brace for prolonged uncertainty?
Exactly. Careful positioning is vital as we navigate these choppy waters. It's imperative for investors to practice caution and adapt swiftly to new data.
Smart moves today can protect investments tomorrow.
Being proactive is key in these uncertain times.
Up next, we dive into whether the market has become blind to the real risks ahead.
Lance Roberts shares insights that could redefine your investment perspective.
Stay tuned. This discussion could be the wake-up call everyone needs.
Credit spreads are at record lows. What does this indicate about the market's perception of risk?
It suggests investors are becoming complacent, ignoring potential vulnerabilities.
Could this lead us into a dangerous situation if a downturn occurs?
Absolutely. And history shows us spikes in credit spreads often precede significant market corrections.
The low credit spreads show a lack of concern for default risk among investors.
That could be dangerous if underlying economic conditions start to falter.
So, is there a clear signal we should be watching for?
Yes, as spreads widen, it indicates rising concerns about credit risk.
With credit spreads at historical lows, what should investors be cautious about?
It shows investors are taking on risk without adequate compensation.
How long can this continue?
The momentum might last, but it creates vulnerabilities.
Historically, we've seen tight spreads lead to market corrections.
Exactly. Investors need to remember these trends.
So should we be preparing for turbulence?
Yes, vigilance is crucial in the face of complacency.
What can investors do to prepare?
Maintain a diversified portfolio and be ready to pivot.
So overall, it's about staying informed and adaptable.
Definitely, that's the key to navigating uncertainty.
As credit spreads widen, we might see market corrections.
It's vital for investors to remain alert.
How proactively should they approach their investments?
Reviewing portfolios regularly is essential for risk management. Key takeaway: never ignore credit market signals.
Absolutely, investors must adapt to evolving market conditions.
It's about long-term strategy and real awareness of risks.
We're diving into market trends today, focusing on the S&P 500 and NASDAQ, analyzing their movements and what they could mean for investors.
Absolutely. It's fascinating how strong bullish signals are emerging right now, despite some doubts in the market.
But are we really out of the woods? What if the market turns suddenly?
That's the key question we need to unpack. Let's explore the bullish signs first.
We're seeing a series of new highs, bolstering the notion of a bullish market environment.
Right? But it's crucial to note these movements don't guarantee stability without a clear bullish trend.
So, what are the critical levels we need to focus on?
The major number to consider is around 610 for the SPY. It's a pivotal point.
Indeed, maintaining above 595 is also integral to avoid bearish signals. If the market starts showing lower highs, we must take heed.
Exactly. Maintaining above 595 is vital for that bullish sentiment to persist.
It sounds like a balancing act between the bullish narrative and cautious monitoring.
The advances are still outweighing declines, indicative of strong internals.
That's reassuring for market participants, but the absence of strong sellers also signals caution.
So we shouldn't start celebrating, right?
Not just yet. Vigilance is key as the year winds down. Looking ahead, I see potential for further gains as long as we can maintain key levels.
But a correction could easily happen if those levels falter.
So what's the takeaway for investors right now?
Key takeaway: stay informed and ready, folks.
Exactly. Let's not get too comfortable. Caution serves us well.
In balance we trust. Let's keep analyzing.
We want to hear from you. Share your thoughts below.
Join our community and let's continue the conversation.
Your engagement helps us all. Thank you for watching.
What an enlightening discussion we've just witnessed.
Absolutely. Each guest brought a unique perspective on the current financial landscape.
From market trends to economic risks, it seems like everyone agrees on being cautious.
Right. But there were notable disagreements too, especially on the urgency of the recession.
And can't forget about the debate on India's economic strategies. They really revealed a divide.
It's essential for our viewers to stay informed and adaptable during these times.
If you found these insights valuable, like, subscribe, and hit that notification bell.
Your support allows us to continue bringing you critical updates and discussions just like these.
Thanks for watching. Dive into our other videos for even more financial wisdom.